Next summer, I will be a loan officer for 20 years. One of the worst experience for any loan officer and for any home buyer is getting denied after you got your offer accepted. It is the worst feeling in the world. It doesn't happen all the time, but it does happen. Tonight, I'm going to go through the different strategies and secrets loan officers use to help people take their loan denial into a qualification. But of course, if you get qualified correctly up front, you might not run into that. But everyone qualifies differently. Depending on how they qualify you, it could happen to you. So tonight, with these strategies, you'll learn how to fix your problem and qualify for more home. What's going on, guys? My name is Min Win with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. If it's your first time tuning in, do me a huge favor. Hit that subscribe or notification button so you are notified every time we go live or post new content. We go live every Monday night on Facebook and YouTube at 9 p.m. And we post our content daily on Instagram and TikTok. So if you're not following us on our other platforms, please go ahead and do so. Also, this is an interactive channel, so ask a lot of mortgage questions. And if this video brings you any value, please like it and tag someone that you know would like this video as well. Right, guys? Tonight we are going to get into how to qualify for more home. What happens when your loan gets denied and you don't qualify anymore? How do lenders fix it? So we're going to go through the different strategies lenders use to fix your pre-approval. How do you get more home? Especially right now, interest rates are going up. Prices are up. Inflation is pushing everything up, but you want to qualify for that home. So what do? Let's find out. If you want a copy of all these notes, instead of typing or writing down notes right now, go to whatsamortgage.com and go ahead and download our Ultimate Mortgage Guide. In the first section of the guide, it's our budget section. We're going to go over how do you budget for a mortgage and how do you qualify for more home. So let's break it down. So to qualify for more home, if you're a lender, or future homeowner, and you're watching this, here's the secret to qualifying for more home. It's the seesaw game. Okay, everything in life has a balance and it seesaws. So first you need to see everyone's income, everyone's credit, everyone's assets in front of you. And you start doing the balancing act and you start balancing things out. Same thing with life. It's all about balance. Once you've finalized all the income, credit, and asset, how do you bring more balance to get more home? Okay, so there's 4 strategies everyone uses. Strategy number 1, drop the purchase price. If you're not that far in the approval process yet, you might need to drop your purchase price. A lot of lenders do that up front, but of course, no one loves that, right? Second one, bringing in a bigger down payment. Third one, paying off debt. But how much debt? We're going to find out in a second. And last but not least, add a cosigner. So these are strategies lenders use to help you qualify for more home. Except for the first one, bringing down the purchase price, but that's if you're not that deep into the process yet. Of course, the most important thing is validate that income first. If you don't validate income, none of this matters. That's why you want to work with a lender. Hey, do you do income validation up front? Not you, Mr. Loan Officer, but does your underwriter validate the income? Once the income is validated, then you start using these strategies to bring down your debt to income ratio, okay? Now let's talk about how to calculate your DTI. Once the lender has validated your income, if you're going with a conventional program, your debt to income ratio is 45/50 on conventional loans, 45/55 on government loans, and 43/43. If you don't know what we're talking about, go to our other live stream and watch how to budget for a mortgage. It's on our YouTube channel. It's also in the Ultimate Mortgage Guide. Once you understand front and back end DTI, it's a lot easier for you to solve your own mortgage problems. So definitely check out that video. If you're a lender, definitely download it. You should know how to budget your buyer's mortgage before you go ahead and start pre-approving them and start running their credit, okay? So let's talk about the first strategy, which people hate, bringing down the purchase price. No one wants to hear that, but sometimes it's important that you know that. The last thing you want to do is fall in love with a home that you don't love the mortgage payment. So you want to make sure, do you need to bring down your purchase price? Right? Bring it down to fit the right debt to income ratio, depending on the program you're going with. It's so important that you know, okay, I'm going with conventional. This is my borderline. This is a government loan. This is where I stay. Jumbo loan. You have 43 over 43, so you have to be a lot more conservative. So know the program, DTI, so you know how to qualify yourself. And then next, validate your income. Oh my gosh. You know how many times loan officers and processors eyeball the income? And then when you get your offer accepted, it's a dead deal. So now you got to bring down the purchase price. Or they pre-approved you and you're out shopping for the home. And then eventually their underwriter validates the income and cuts the income and you qualify for less home. So it's important, right? You know your DTI, right? You call your lender, you talk to them. Hey, I already know I'm 45 over 50 because what's the mortgage told me. Where's my DTI at? So you know your wiggle room. Once you know your DTI, you know you can go more home or less home. Very important, okay? You know the program. You don't need to write it down. You can go to what'samortgage.com and download the guide. Of course, once you figure out your DTI, you know your income. Now you decide, I need to back off on purchase price. So you might need to shop somewhere else. Doesn't mean you don't qualify for a home, but maybe not the home you want yet. So that's why it's important, right? That you know your income, you know your DTI, then you start playing with the purchase price. Of course, no one wants to hear that. So the second one, bringing in a bigger down payment. Okay, I use this one second. Some people use this one first. I use this one second. Right, the third one I use more. We'll go over that in a second. So bringing in a bigger down payment. So before you decide to bring in a bigger down payment, validate that income. I'm gonna say that over and over again. That's where most loan dies because the income is not validated. You want to work with a lender that validates that income. You want them to verify with your employer. You want to know the exact income, that number is not going to change. Also on your side, don't work less hours. Don't make less money while you're shopping, okay? Second one, what is the correct down payment to bring down your DTI? Of course, you want to know the minimal down payment for the program. And then you start putting in, increasing it. Let me increase it by 5,000, 10,000. You start increasing it slowly to bring down the DTI to fit the program that you're getting. Third, how long will it take for you to save that money? Of course, if you're in escrow, you might need a gift. If you're not in escrow yet, that's why I want you guys to go get pre-approved ahead of time. In case you're not qualifying for the home you want and you want to qualify for more home, find out how much more do you need to have to bring down the DTI. How long will it take for you to save that? Can you save within a year? If you can't, you have to stress about home appreciation. Find out how fast home appreciates in the area you want to buy. Can you save fast enough? Some of you guys, you qualify, I want a bigger down payment because I want a cheaper payment. Maybe you can't save your down payment quick enough, and by the time you save it, homes might cost more and you're gonna be shopped out of the market. And I see that happen to so many home buyers who did qualify. Of course, they don't want things to be too snug. So they're like, let me save more money. And by the time they save it, they're shopped out of the market. Does that sound familiar? A lot of people are shopped out of the market because they try to save that 20% down, not have PMI, or they didn't want to come down on purchase price. Like, no, this is my dream home. I'm going to fight for it. I'm not going to eat anything besides air for the next couple of days or next couple of months so I can save that bigger down payment. So be careful. As you're saving for more, you might want to pay attention to that. And of course, there's other solutions besides bringing in a bigger down payment. Maybe you have extra money to buy out the PMI on a conventional loan. You can buy out the PMI, which will help you qualify for more home. Or buy down the interest rate. Right now, in 2020, summer 20 or fall 2022, the market has softened. Depending on the market you're in, you can get the seller to buy out your PMI, buy down your interest rate so you can qualify for more home. We had a scenario last couple of days, instead of the seller having to put the house back on the market and being scared to get a lower offer, the seller just paid off the PMI, or they just bought down the interest rate, which happens a lot right now. All right, so when you're talking to a lender, make sure they have strategies. Okay, it's too late. They're in escrow. Number one, out the window. They can't go with the lower purchase price. Number two, right? Do they have extra money? That's why when you talk to your lender, you want to have all your assets ready so you can decide, hey, I can come in with more, or hey, let me go ahead and buy it down the rate or buy out the PMI. Depending on your down payment, sometimes the seller can't help you with everything. Remember, on a government loan, on FHA, you can get the seller to cover up to 6%. VA loan, 4%. Conventional loans, less than 10% down, 3%. 10% down or more, 6%, right? So definitely know your down payment so you know how much you can squeeze from the seller if it's a buyer's market. Now, the third strategy, which is the most popular, most lenders use to bail themselves out of problems. If they pre-approve somebody and the processor and underwriter cut the income, everyone goes to strategy number 3 first, paying off debt. It's the most popular one, okay? It happens a lot. You're in escrow like, oh my God, I got to pay off debt. So if you have debt, how much debt do you have to pay down? If you don't have debt, you can't go with this strategy, of course. You have to go strategy number 1, bring down the price, or strategy number 2, bring in a bigger down payment, or buy out the PMI, or buy down the rate. Depending on where rates are at, I typically calculate a $50,000 mortgage to see how much debt people have to pay off to get more home. Okay? How do you qualify for $50,000 more home? If rates are at 3%, it's about $340 a month, will give you $50,000 more buying power. So you come in with strategy number 2, $50,000, or if rates are at 3%, you pay off $340 a month in debt. If it's rates are at 4%, you pay $370, 5% you pay $400, 6% you pay $430, 7%, which we're at kind of right now in fall of 2022, is $460 a month. Why does my number look higher than most people on the internet? My number includes tax insurance. If you're trying to qualify for more home, taxes are higher on higher purchase prices. Taxes are higher on higher loan amounts because you're going with a bigger purchase price. I factor that in. I'm not a lot of lenders factor that in. So you can fall into that trap where you're like, oh, I did what the other lender said. I paid off $300 a month in debt. I should qualify for $100,000 more home. Wrong. You got to take in consideration tax and insurance. That's why you got to watch what's a mortgage, okay? So a lot of times, this is where we're sitting. You got pre-approved. You're out there shopping. You got your offer accepted. Some lenders, and it's kind of sad to say, they're so cheap. They don't want to spend money verifying all your documents because you might change lenders. So it costs them about 80 to 100 something bucks to verify all your information, right? Sometimes two, depending on how many times they're verifying it, depending on your credit, how much stuff they want to verify. They're not going to go out and spend 200 bucks, right, to verify all your information until you got your offer accepted. But then when you get your offer accepted, all of a sudden they verify everything and they cut your income, you don't qualify. So what comes first, the chicken or the egg, right? So I don't want to verify your stuff until you got your offer accepted. But you get your offer accepted, everything wasn't verified, you're not approved. So make sure you're working with a lender that has deep pockets, but when they have deep pockets, guess who they charge the bill to? To pretty much you. They're raising prices on everyone else because they're taking into consideration all the fallout. No one should have told you that. Shh. Thank goodness I did, right? So a lot of lenders that do verify, sometimes their fees are higher because they verified on people who didn't qualify as well. So it sucks, but this is just reality. So that's why when you get approved, you want to look at the loan estimate, right? And then you want to say, hey, did you verify my income? Did you verify all my assets? Did you verify all my information? Because I don't want to go out there and shop and you're going to cut my income. But this is how lenders bring it down, right? They bring down your DTI by looking at your debt. What can I eliminate? Oh, Susie got qualified for more home than her income. What debt can we pay off? The more debt you pay off, the more you qualify for. It's easier to pay off debt than to come in with $50,000. So right now, if you looked at all your credit cards and whatever balance you have on your debt, it's cheaper to pay off those little debts that have higher payments than to come in with $50,000. And that's why I like strategy number 3 more than strategy number 2 by bringing in more money. Maybe paying off debt will help you qualify for more home. If you have mortgage questions after our live, I'll go ahead and answer all your questions, all right? So bring on your questions. So number 3 is my favorite, paying off debt. Of course, if all that income was verified up front and you're like, man, I'm not happy with this home, then talk to your lender, look at your debt, find out where rates are at. Hey, I want to qualify for $50,000 more home. I saw this $8,000 credit card that has a $400 payment or $430 payment. Let me go ahead and eliminate $8,000 so I can qualify for $50,000 more home. That might be doable. Use your 401k. Maybe get a gift. Pay off that debt, right? There's all this strategy you can use. That's why it's better to get approved upfront with the lender that verifies your income and asset with their underwriter, so you don't go out their shop and then you go to escrow and you're dead. Right? Your deal died. So, all right, so that's number 3. Now let's talk about my least favorite, but most people do this. They add a cosigner, okay? First of all, I'm not against adding a cosigner, but remember this. With much power comes much responsibility when you add a cosigner. Carefully choose who you decide to have as a cosigner with you. Just because someone has nice things, it does not make them a perfect candidate. So I see this happen all the time. They pre-approve you, you go out there shop, your income got cut or something happened, or they can't use your spouse, but you're going with a government loan where you have to add your spouse's debt. And now you don't qualify. And now you have to add a cosigner. Happens a lot, more often than you think while you're in escrow. I see it happen a lot. For some reason, if you're self-employed, they cut your income somehow, or they didn't let you use all the income that you thought you were going to be able to use, or you changed jobs, and they can't use your overtime or bonus, or you had a second job, but for some reason they can't use it, or you had a cosigner or someone who's going to help you with a mortgage payment can't be on the loan, but the money's there to make the payment. Okay, adding a cosigner is not that bad. But if you straight up don't qualify, but you want to add somebody just so you qualify, you're just setting yourself up for failure. If you're not approved, but no one's who's co-signing for you is going to help you with the payment, or someone co-sign for you, but someone else is going to help you with the payment, don't add a co-signer. That's why adding co-signers is a lot of responsibility. The stress of not messing up someone's credit. Also, when someone's added to your loan, like if you add me to your loan, I want 25, 50% of your equity. That's just me because I'm co-signing for you. You might have a family member or friend that might not want to do that, but if I'm using my credit so you can get a gain, I need a gain. Okay? So I see that happen all the time. Let's talk about the perfect co-signer. Who should you use then? Right? Who should you use? Only add a co-signer if you have people who are helping you with the payment and they can't go on the loan. Or for some reason, the lender can't use your full potential income. Remember that. Listen to Uncle Min. Don't get caught slipping, and now you have a payment you can't afford. The qualification of a perfect cosigner must have the same or better credit score than you, or you can get a boo-boo rate. Must have a solid job. Must have low to minimal debt. Must not currently be paying rent or a mortgage, because rent or mortgage also count as debt as well. Okay. Of course, if they do have a mortgage, but they make tons of money, or debt and they make tons of money, then not a big deal. But it's very rare to find that. Okay. The reason why you want someone that have better credit than you, let's say you have a 780, they have a 660. Now you're going to FHA, you have the permanent PMI. Of course, if that's the only person going to help you co-sign, it is what it is. But when they have, they don't have good credit, but they have good income and they barely make enough credit to qualify, it's going to maybe put you in a different loan program or payment you might not love. Okay. So you want to find someone with the same credit or better. They must have a solid job. If they don't have a solid job, the lender can't use their income. Next one, minimal debt. You know, everyone's got that cousin, that uncle that's flashy, or that relative that's flashy. Like I can ask Uncle Rico, cousin Hector, right? Or, you know, just your aunt who has like a brand new car. No one knows that car is a $2,500 G-Wagon car payment, or a $1,000 Mercedes payment, or a $700 G payment, or they got a timeshare somewhere that all those payments affect your debt to income ratio. But like I said, they make tons of money that's verifiable, not a big deal. But most of the time that doesn't happen. So be careful asking people close on. Maybe they are able to borrow a bunch of money, but for a mortgage, income does matter. Okay. If they're paying rent or a mortgage, that debt's added onto them. If you're going FHA and that cosigner is married, you got to add that spouse's debt as well. So be careful picking a cosigner. The perfect cosigner is going to be your nephew or niece, uncle or aunt that lives at home with their parents. You ever got that weird uncle, that weird brother or weird sister that's in their 30s or 40s? they have their stuff together, but they live at home and they don't want to go out and they're frugal, that's the perfect cosigner. Or you got that nephew or niece who just finished high school, but they got a full-time job, they got a little credit card, best cosigners. They have minimal to no debt, right? But of course, there's cousins, uncles, and all that have debt. But I'm letting you know, when I see people qualify, they add someone with pretty much almost no profile or no family activity. It's easier when they're single, okay? Not saying that married people can't help you, but it is rare. Now let's look at how much they need to make, okay? So if you add this cosigner, this is how much they need to make. If you're already qualified and you're scrambling looking for a cosigner, get this chart down. You can always go to whatsamortgage.com and download this chart, right? So if rates are 3%, you're trying to qualify for $50,000 more home, they need at least $680 a month in gross income with no debt. Of course, if they have debt, you got to make more money. 4%, 740, 5%, 800, 6%, 860, 7%, 920 to qualify for $50,000 more home. So what I did was I took the debt, times it by 2, right? Took the 50,000, we did it on our other slide, times it by 2, the mortgage payment, that's how I got the number. So if you're scrambling, that's what you want to look for to get $50,000 more home. Let's say you want to qualify for $50,000 more home, but you can't add the cosigner or someone who's going to help you with the mortgage payment. Go out and look for a cosigner that fits the criteria and makes that income, and you will be able to qualify for more home. So if you're not in escrow yet, woo! Now you can come up with a perfect strategy to qualify for more home. If you're in escrow, these are how most lenders solve your problem if income has been validated. Of course, number one is attack the income to try to squeeze out more. But once income is validated, either bringing down the purchase price. If you're in escrow, you can't do that. Bringing in a bigger down payment, paying off the PMI or buying down the rate, paying off debt. Last but not least, add that cosigner. Okay? But remember, be responsible about it. Right? Don't get a donk and add your Uncle Rico, who's got a G-Wagon payment, which is like $2,500 a month, and finance all the jewelry, jewelry and everything. You don't want anyone who does that, because most likely if they had to finance their jewelry, they're not going to help you qualify for a home, okay? Hopefully this information helps you out. And if it did, do me a huge favor. Hit that like button and tag someone on this video that you know this video will bring them benefit. Or save it. If you're not buying now, you're going to buy in the future, save this video, all right? And if you're not following us by now, do me a huge favor. Hit that subscribe and notification button so you're notified every time we go live or post new content, all right? Hopefully this information was valuable to you. And for everyone who wants to get a hold of me, a lot of you guys are messaging us. Here's how you get a hold of us before we get on the Q&A. If you have mortgage questions, bring them on, okay? So give us a call, 714-790-9697. Give us a call. For the shy guys, shy girls, send us a text message, right? Text us, 714-790-9697. Say, peekaboo, I see you. Or you can email us, info@whatsamortgage.com. You can email us your scenario, or if you have a loan estimate, like, Min, I like this guy, right? Like, I like that guy, Min. Maybe he can help me find a better deal. If you have a loan estimate, not from a builder though, we're pretty much, it's hard to beat a builder. If you have a loan estimate and it's not new construction, bring it to us. Hopefully we work with probably like 50, 60 lenders. Hopefully we can find a lender that will beat the deal you have. If we can't, at least we tried our best. Every dollar counts in closing costs, right? Because if you buy a house, you still have supplemental taxes coming down the road. So you want to save every dollar you can. Every dollar on your monthly payment helps, right? If you're going to be at home saving money, at least you want to have Netflix. At least you want to have Hulu, right? Or Prime. So every dollar helps, right, guys? So go ahead and bring us your mortgage questions and we will answer those. That's how you get a hold of us. All right, mortgage questions here. What's going on? Rose Abraham, how you doing? DJ Marcinia, how you doing? Abdul Wahid, I approve to purchase a home in Sacramento, California. Can I change it to buy in another city or state instead of California? Yes. If you qualified owner occupied and it's going to be somewhere over an hour away from your work, you want to get a letter from your employer saying that you can work remotely, or because it's 2 hours away, you only have to come in 2-3 days a week. It just needs to make sense owner occupied. Investment or second home, completely different story. If you don't own a property yet and you buy an investment home, you cannot use rental income to help you qualify, so be careful. If you buy a vacation home, Don't forget, they're going to qualify your vacation home, the mortgage payment, and they're also going to add your current rent on your mortgage right now. So you have to make more money if you're trying to go with a vacation home, all right? DGLG, what do you think about renting out your home instead of selling it? I love that. Let me tell you why, DGLG. When you sell your home, it costs about 7 to 10% to sell your home, okay? That means the equity is, bye Felicia, gone. When you rent out your home and you need to borrow money, you can borrow up to 90% of the appraised value. So you can still keep 10% of your home. Just make sure the payment makes sense. Make sure, DGLG, you have a great exit strategy. How much can your home rent for? If it can't be a regular rental, if it's going to be a short-term Airbnb, remember to notice vacancies as well. The 60-70% of the time it's rented out isn't enough to cover the overall mortgage payment. I would prefer you do that. If you're holding on to a home, especially in a metropolitan area, I know we're in a slump right now because rates are rising, but they're going to pull it back because we can't survive with these rates. So when they pull back and more people rush into the buying market, it's going to drive prices back up. Understand this. Builders, because of where rates are not building single family homes. They're building units to rent out. So homes are going to become an insane commodity a couple years down the road. So if you have an asset, unless you really need to sell it, hold on for dear life. If you have a home in San Diego, LA, Orange County, Sacramento, San Jose, hold on to it. Okay? Also other areas, like I know Idaho and Boise and Meridian's having some issues in Idaho, but it will bounce back because they're not building more homes. Out of all the properties they're scheduled to build, only less than I think 50,000 homes are built. Out of almost 500,000 homes, I think it is. I forget the number, but only 50,000 homes are built. They're not going to finish those other ones till down the road because it's just costing them too much money. All right. So I say keep it. Jay Garcia, can someone qualify for a home with a 620 credit score and $5,000 a month in debt? Yes, depending on their income. That debt, what's the monthly payment? Jay Garcia, you can probably go with an FHA loan, right? Hopefully that helps you out. Noel, what's up, man? Thank you so much. Novilla, sorry, not Noel, Novilla. Abdul, thank you so much. Abdul, my friend, makes $50K a year on W-2. How much can he qualify for? Depending on his debt, Abdul, please message me directly, 714-790-9697. Give us a call, text us, or email us at info@whatsamortgage.com, okay? See, no Villa, if I'm giving 10% down on an FHA loan, when can I get rid of my PMI? If you put 10% down on FHA loan, on the 11th year, your PMI will fall off. If you put 10% down and you gain 10% more equity, you can refinance from FHA to conventional and remove your PMI. Hopefully that helps you out. All right. I really appreciate everyone who watched today and everyone who stayed till the end. If you're not following us by now, do me a huge favor, hit that subscribe or notification button. Right. Also, everyone who engaged, I really appreciate it. I appreciate all you guys who've been watching us for the last 5 years. You don't know how much it means to me that you guys have been on, watching, and staying loyal. Right. And also thank you for referring people. Thank you for everyone who liked, commented, and shared after all these years. I feel like every time I'm on, it's like I'm seeing you guys for the first time again. I'm so amazed. I'm so appreciative. I'm so thankful. So thank you guys so much. We want to end all our episodes with our attitude is gratitude. Without you, there is no us. So thank you guys so much. And